Open your January Social Security deposit and count what actually landed. Your raise for 2026 was $56 a month. 38 of them showed up. Medicare took the other $17.90 before that money ever reached your bank. Not the Social Security dollar, the Medicare Part B dollar. No bill came, no line item. It was simply gone. Not a penalty, not an error. A second number that moves every January at the same time the raise does. And it will be waiting for you next January and the one after that for the rest of your retirement. The raise gets the headline in October. The premium gets a press release in November. Almost nobody sets the two next to each other, which is how a raise disappears in plain sight. So let us set them next to each other. The average retired worker's benefit went from $2,015 a month to $2,071. The 2.8% cost of living adjustment for 2026. In the same window, the standard Medicare Part B premium went from $185 to $202.90. $56 in. $17.90 straight back out. $38.10 landed. 68 cents on the dollar. And that is the clean version. Nothing unusual on your tax return 2 years ago, a bank account already on file, no help sitting unclaimed with your name on it. One retiree you will meet in a minute pays $6,300 a year because one of those numbers went the wrong way. 3 things stand between the Social Security Administration and your kitchen table. 2 of them shrink the raise. The third can stop the deposit from arriving at all. And one program can hand the whole premium back. In the next 15 minutes, you will see exactly where your own raise went, which of the 3 took it, and the 2 pieces of paper that can move it back. I am your guide to the retirement money decided by paperwork nobody hands you. Quick favor before Part 1. If that is worth 15 minutes, tap like and subscribe so the next one finds you. Part 1. The premium that moves first. Ray is 71. 34 years with a county road department in Ohio, and his benefit sits almost exactly at the national average. December's notice said it was going up $56, and he did what most people do with that number. He put it against groceries. Then January's deposit came in $38 higher instead of $56, and Ray called his daughter, sure something had been miscounted. Nothing was miscounted. The Part B premium is pulled out of the Social Security payment before it goes out the door, so the raise and the premium increase settle against each other inside the system. What you see is only the difference. It arrives as an absence, and the premium is not the only Part B number that moved. The annual deductible for 2026 is $283, what Ray covers himself before Part B pays anything. So the first medical visits of the year land on him too, on top of a raise already a third smaller than the headline. Now here is the piece almost nobody knows, and it is the reason the check does not go backwards. There is a provision in the Social Security Act called Hold Harmless. For roughly 70% of Part B enrollees, the dollar increase in the premium cannot exceed the dollar increase in the Social Security benefit. In plain terms, the premium can swallow the whole raise, but for most people it generally cannot cut into the check they already had. Here is why that rule exists. Take a thin work record, $600 a month. 2.8% of that is $16.80, and the premium increase wanted $17.90. Hold Harmless caps the increase at $16.80, so the deposit stays flat instead of shrinking. The raise was real. It went to Medicare, every cent of it, and stopped there. Hold Harmless does not cover everyone. It generally does not apply in your first year of Part B if you are billed directly instead of having the premium deducted, if a state program pays your premium, or if you pay an income-related surcharge. That last group is where the second bite comes from, and that one is not $17. Part 2. The surcharge built on a tax return from 2 years ago. Dale is 69, single, and 2 years ago he sold the house in Sacramento he had lived in since 1988. The sale went beautifully. $400,000 of gain. Because he met the ownership and use test, the first $250,000 of that gain is excluded from his income as a single filer. Real, generous. And the sentence where most people stop reading. The other $150,000 does not vanish. It lands in his adjusted gross income. Stack it on the $70,000 he already had from a pension and withdrawals, and Dale's modified adjusted gross income comes to $220,000. 2 years later, his monthly Medicare premium is not $202.90. It is $649.20. That is IRMAA, the income-related monthly adjustment amount. Medicare prices your premium off the modified adjusted gross income on your return from 2 years back. Adjusted gross income plus tax-exempt interest. Not last year's return, the one before it. For a single filer in 2026, the standard premium holds up to $109,000 of that income. Above that line, the tiers begin. For a married couple filing jointly every threshold, but the very top one is exactly double, $218,000 for the first, and each spouse pays a surcharge on their own premium. Dale's tier runs $446.30 a month above the standard premium, plus a matching Part D surcharge of $83.30 on top of whatever his drug plan charges. Add them, and a house he sold 2 years ago costs him more than $6,300 in Medicare premiums for 1 year, on money he will never see again. So, a 2-year-old tax return sets today's premium. Which raises the obvious question, can you tell them the event is over? Sometimes, yes. There is a form for it, SSA 44. Be precise about this one. Check an event Social Security does not recognize or leave off the proof, and you lose a month. SSA 44 is not an appeal arguing the number is too high. It asks Social Security to price your premium off a more recent year because a life-changing event cut your income. It recognizes 8 such events, and only 8: marriage, divorce or annulment, death of a spouse, work stoppage, work reduction, loss of income-producing property, reduction or loss of pension income, and an employer settlement payment. Notice what is missing. Selling your house is not on it. A capital gain is not on it. A large Roth conversion is not on it. And look closely at that 6th item, because it fools people. Loss of income-producing property means the property was destroyed or taken from you by something outside your control. It does not mean you sold it. Choosing to sell is not a life-changing event in Social Security's language, however much it changed your life. So Dale files nothing for the sale itself. What rescues him is the calendar. The surcharge is priced year by year, and once a return without that gain works through, the premium comes back down on its own. One expensive year, not a permanent one. And if he stopped working that same year, work stoppage is on the list. That part he can file on. Carol's situation is the mirror image, and hers is the one worth memorizing. She and her husband filed jointly 2 years ago with a modified adjusted gross income of $240,000. He was still consulting, and they took a large distribution. That put both of them 1 tier up. He died in February. Her income this year is roughly $95,000, comfortably below the single filer line. And Medicare is still charging her the surcharge because this year's premium was set by that joint return. Death of a spouse is on the list. Carol files SSA 44, checks that event, attaches the death certificate and an estimate of this year's income, and asks for a new determination. Where the reduction is significant enough to change her tier, the surcharge comes off. Not as a favor. As a recalculation she is entitled to ask for. One honest warning for every widow and widower watching. Getting the surcharge removed does not fix what comes after it. From here on, she files single, and every one of those income lines is half of what it was when there were 2 of them. The same retirement income that sat safely inside the joint thresholds can sit above the single ones. SSA 44 does nothing about that. Only the order and size of the withdrawals does. Part 3. the payment method that is being retired. The first two take a piece of the raise. This one is not a Medicare charge at all. It decides whether January's deposit reaches the bank. In March of 2025, an executive order directed the Treasury to stop issuing paper checks for federal payments, and as of September 30th of that year, federal benefits are paid electronically. Fewer than 1% of beneficiaries were still on paper. A small group, with the largest single thing to lose in this whole video. So if a paper Treasury check still arrives in a mailbox you know, yours, your mother's, the neighbor you look in on, that delivery method is going away. 2 replacements, 1 narrow exception. Doing nothing is the option that does not work. Direct deposit into a checking or savings account is the first. Set it up in a My Social Security account online or by phone. For someone with no bank account, and there are more in this age group than most people assume, there is the Direct Express prepaid debit card. The benefit loads onto the card each month. Enrollment runs through the Treasury's Electronic Payment Solutions Center at 800-333-1795 or at godirect.gov. One note for 2026. Direct Express moved to a new financial agent, so mail about an existing card transferring is legitimate. The Treasury, not Social Security, also runs a narrow waiver for people who genuinely cannot use either. And because this is precisely the kind of change criminals wait for, check anything about a card transfer at godirect.gov. Never with someone who called you. Social Security will not pressure call you for your bank account number. If a caller pushes you about your deposit, hang up and call Social Security yourself, at the number on your own notice. A raise cannot reach you if the payment cannot. Which brings me to the one part of this where the money moves back toward you. Part 4. The help most people never ask for. Marie is 78, in Georgia, living on $1,430 a month. Her Part B premium is the same $202.90 that Ray pays. On her check, that single line is 14% of everything she gets, and Marie has likely qualified for years to have that premium paid for her. They are called Medicare Savings Programs. They run through your state, and there are 3. Every number I am about to give you is the federal baseline for 2026. Several states run more generous rules, and some do not count resources at all. So hear these as the starting line, not the verdict. QMB, the Qualified Medicare Beneficiary Program, is the strongest of the 3. It pays the Part B premium and any Part A premium, and providers generally cannot bill you for deductibles, coinsurance, or copayments on covered services. The individual limits are $1,350 a month of income and $9,950 in countable resources. For a couple, $1,824 and $14,910. The Specified Low-Income Medicare Beneficiary Program, SLMB, pays the Part B premium up to $1,616 a month for an individual and $2,184 for a couple. The Qualifying Individual Program, QI, also pays the Part B premium up to $1,816 a month for an individual and $2,455 for a couple. QI has to be applied for again every year, and states approve on a first-come basis, so January matters. All 3 are applied for the same way, through your state, at the office that handles Medicaid. One application. The state decides which of the 3 you land in. And the income a state counts is not always the gross figure on your statement. Certain amounts are disregarded first, and the limits run higher in Alaska and Hawaii, which means being over the number on paper is a reason to apply, not a reason to skip it. On the drug side, there is extra help. The Part D low-income subsidy, and Social Security administers this one directly rather than the state. In its own count, a couple of years back, Medicare put roughly 3 million people in the eligible and not enrolled category, and Social Security estimates the program is worth about $4,000 a year. Marie's raise this January was $40 a month. The program she never applied for is worth roughly $200. Here is the one rule to take out of this. The raise is not the number that decides your year. The gap between the raise and the premium is, and you can find that gap in 10 minutes out of 2 documents you already have. The first is the notice Social Security sends in December, or the message in your My Social Security account. It shows the new benefit amount and the Medicare premium coming out of it. Subtract. That is your real raise. The second is your tax return from 2 years ago. Find the adjusted gross income, add any tax-exempt interest, and compare the total against $109,000 single, $218,000 joint. If you are near either line, you already know what your premium does 2 years from now, and you still have time to move it. Pull the notice, do the subtraction, then go look at the return. And I will say the careful part out loud because it matters more at this age than at any other. This is education, not financial advice and not legal advice. Walk your own household's numbers through with a fiduciary or a free benefits counselor before you move anything. Premiums, thresholds, and limits reset every year. The figures here are this year's. If a number in this one caught you off guard, type the word premium in the comments. It tells me to keep going on the Medicare side of retirement, where $17, $200, or $6,000 can leave before you notice. And if this saved you a phone call you did not know you needed to make, tap like and subscribe. That is how it reaches the next retiree who is quietly $38 short and does not know why. See you next time.